Hello, everyone, and welcome to the first installment of the Sunipro Roundtables, where we discuss top-of-mind subjects with industry experts. My name is Pranav Patel, Managing Director with Sunipro. Thank you for joining us. Our topic today is M&A due diligence and the growing importance of cybersecurity in the IT diligence space. Over the past 5 years, cybersecurity has really crept up as a financial and technical driver in many deals. With that, I'd like to introduce our panelist, Saad, M&A consultant with over a decade of experience in financial due diligence and also a PhD professor with the University of Houston System. Next, Scott Edwards, 14 years of experience in investment banking, working with both the buy and sell side of M&A transactions, currently focuses efforts on commercializing technologies in the energy space. And finally, cyber guru Amir, Chatur, senior engineer with Rackspace, focusing in the cybersecurity area. Again, thank you for joining. I want to start with a general question. It's been a hectic environment through COVID and the unforeseen post-impact of COVID. What are your thoughts in terms of the deal climate at this date and where the opportunities are?
Thank you, Pranav, and glad to be part of this panel. So I think when I think M&A climate, it really is vastly different depending on the industry, sector, and organizational life cycle, if you will. We've seen, as you can imagine, the healthcare sector booming in activity, as well as the pharmaceutical, and so all the industries that ended up benefiting from the pandemic in some form had a more positive or more aggressive M&A market as compared to some other industries that were on the negative end of the pandemic. And then there's all the in between. For example, oil and gas. There was some sense of consolidation opportunities that presented themselves. Some companies wanted to jump in and take advantage of the low multiples. But there were also a lot of hold your dollar and wait and see how things shape out. And as the oil prices start to change, you see that dynamic play out more aggressively in the market. So I really think it's been an interesting time. And I think more than ever before, the gap between organizations in different industries has become a lot wider, and there's a much bigger variation across all industries, I think.
Right. So you mentioned healthcare is kind of one of those opportunistic industries. So did you say energy is kind of in the middle of the spectrum, or were they maybe on the lower end, looking at specific opportunities as they come by?
Yeah, I honestly struggle with the energy sector because the more you speak to executives in the energy sector, some of them are still believing in the mindset of this is a good time or was a good time as oil prices were lower, multiples are low, and it's an opportunity to go consolidate and acquire assets and such. But then you speak to others and you sense the cautious attitude of or caution attitude of like, let's wait and see how things shape out. And also, obviously, a big driver is which part of the value stream, industry value stream are you on? The upstream was very attractive for acquisitions when oil prices were down, obviously, with the oil field services and such. But then on the downstream side, the primary raw material for you is very cheap, so you're achieving good results, but then demand is not where it used to be. And so I struggle. I'm really curious to hear what others think of the oil and gas industry specifically and how the trends are there.
Agree. And really, this brings us to Scott, who's been in the M&A industry for quite a while. Scott, would love to get your response around that, as well as your thoughts in general around the M&A environment.
Sure, thanks. Yeah, as Sal mentioned, the energy complex is pretty complicated and it spans so many different parts of the economy that you could almost talk about each one individually and how that M&A environment is evolving. But we've seen that is a very cyclical industry. In my career, I've been through, this is the fifth up cycle, and so that means there's been four down cycles. And you see M&A in both. but remember that the peers trade sort of in concert with one another. So when company A is trading at a low multiple, so is company B, the target. And so it's always you see in corporate M&A that there'll be a lot of stock for stock deals, both in the up and down markets. What you see when asset deals are getting done is that public companies are using up markets to acquire private companies from private equity firms at multiples that are less than they're publicly trading for, so they get an accretive uplift in the public market. And everybody wants to grow their asset base and their inventory of drillable locations. I'm speaking more of upstream right now. And so in this environment where everybody's cash flowing like crazy, it's really hard to get deals done because everybody thinks they're worth more than the acquirer thinks they are. So that's the struggle for a guy like me who sits in the middle and tries to bridge that gap. So there has to be true synergy between companies beyond just the asset value of the business. So what technological advantage or is one company achieving a better cost of capital than the other? Then they may have an advantage and want to go ahead and take a swipe at a transaction. Or does the target possess some special technology or just a lower cost of drill and completion, and so the acquirer wants that knowledge and that technology? Then so there's a place to get a deal done. Right now I think it's kind of choppy. I don't see a whole lot of M&A activity on the corporate side going on. I think we're going to see more asset deals as especially on the upstream side for the time being. When you get into industrials, more broadly speaking, I think you'd have to have synergies in terms of personnel, systems, things outside of the core, just operating businesses. And then you got geographic locations to consider. So you really have to be strategic in how you're thinking about M&A all the time. But I think during really robust markets where there's cash flow going crazy, you have to be extra strategic because you got to prepare for that next downturn. And where are the weak links in that target? And so you've really got to look for the risks because everything looks rosy right now. But only the negatives are exposed, the risks are exposed when you go into the next down cycle, which no one can really predict when that's going to be, but it's coming because that's just the nature of the business. So I don't know that that's a definitive answer on what's happening because I wish I could predict the future. I'd be a lot more successful, but it's really being tactical and being strategic and thinking about the risks that come to the surface when times go to where they always do, which is the down market. So I think this panel will have some more discussion around what those risks can be, and cybersecurity is definitely one to be aware of. How well you can integrate in that target to your cybersecurity protocol.
That makes sense. As a market is opportunistic, augmented valuations will follow. As we talk more and more about cyber, Amir would love to hear your thoughts on what the key areas of focus are within cybersecurity.
On the security front, I mean, it's just getting worse and worse as the time is going by. Especially during the COVID time, it seemed like more hackers were actually coming around. I don't know if you guys have ever had a cloud server of any kind, but just putting one up and just having it out in the open, you'll see if you're monitoring your network traffic and everything. Daily, it's hourly where there's Chinese hackers, Russian hackers, all kinds of different, they're just trying to own your box. And honestly, the way it looks is they just have like the big IP spaces from all the big ISPs that are out there, and all they're doing is sitting there and scanning this. What is open? What's listening now? Okay, well, this is here now. Let me see if I can try to do something with it. And most people, when they actually do create a web server or whatever on the cloud, they're not thinking about, oh, let me go ahead and secure this password to the point where it's not going to be hackable. AWS, on the other hand, if you do create a password, a server with them, what they do is they make it a little bit more secure, where they're trying to do no longer password-based access, right? It's all security-based access. And the way I'm looking at it, that's kind of going to be how security is going to work in that realm. It's going to be less password and more, certificate based. So
when you say less password, do you mean SSO, like single sign-on, or
even with
is
single
it a little
sign-on,
bit more complex?
I mean, in the sense of like, let's say you're trying to log into a server or something of that sort, you're not going to actually use your password. You're going to use a certificate key-based exchange, right? So your private key is sitting on the server, your public key is here. So public key can be given to anybody for that matter, and it doesn't matter, right? So it's just as long as you have the two pairing, that's the only way you're going to be able to communicate with that server. So
Over the past few years, how have you seen the impact of cybersecurity in discussions with M&A leadership and other stakeholders in the due diligence process?
Yeah, I think so. Deals are sitting in the center of this onion, if you will, and there are multiple layers. The first layer typically is the structuring environment of the deal itself and how, whether it's asset or stock or a merger and so on. But then there's that transactional environment, which is, I like to think of it as micro external environment. So it's market conditions, preferred financing mechanisms based on the interest rates and such, the transaction characters and the business plans and the aspirations of a business. And then there's the macro external environment, things that include antitrust laws, securities, corporate laws, tax regulations, accounting, and so on. And I see cybersecurity as kind of cutting through the onion all the way down to the core of the deal, in that there is a macro level risk that is represented by cybersecurity, but there is also external micro level risk. So specific markets are being more vulnerable or being more targeted than other markets. So if you're executing deals in those markets, there are additional considerations to be had. And then the true and real impact cybersecurity is having on values of organizations. I mean, I don't remember for example, back in the 90s, a lot of deals that had an adjustment on their EBITDA primarily focused on the risk exposure or cybersecurity exposure. And so companies are becoming a lot more conscientious of the cybersecurity risk. It's a lot more real. And like Scott mentioned, if you are in a certain geography, in a certain segment of the value chain, and your exposure is higher, like midstream, for example, terminals and pipelines and such, it has become a more tangible force in determining values of organizations as well as merits of deals. I've seen executives and board members think when there is very high level of exposure that they don't feel is managed effectively, they're willing to walk away today, which wasn't the case 20 years ago.
Yeah, that's interesting.
So, yeah, it's become a lot more serious consideration for transactions. And I also remember the times when due diligence did not necessarily cover the IT side of things. A lot of times it was primarily focused on EBITDA and financial considerations and such. Today, IT diligence has almost become as foundational to any deal as the financial diligence, which determines the value of the transaction and such. So I feel like it's become a lot more forceful, a lot more present, and a lot more impactful or influential on the decisions of deals.
Yeah, I was actually going to ask, and you kind of answered it. Have you seen a deal actually get killed, right? Pencils down because of a cyber risk, and sounds like you've seen that. I guess on the flip side, have you seen an organization, a target acquired, where they maybe overlooked that cyber risk, but then down the line, some of those impacts have come to fruition and really made the valuation that was determined up front not come to fruition, or even possibly back out on the deals.
Yeah, and I haven't seen that specific scenario, but what I've seen is when an organization has really strong cybersecurity environment, I have seen that become an attraction point for acquisitions as well. Not necessarily by itself. I haven't seen anybody go out to buy a company just because they have good cybersecurity. But there are scenarios where if you are acquiring a company and you realize cybersecurity is strong there, you're actually, at least internally, creating or allocating more value on that cybersecurity and make that a central consideration for integration. A lot of companies are taking the best of both worlds approach in integration. The tuck-in is not as common. Maybe the exception is private equity and such. But if I'm making a transaction and I find that the target has really strong cybersecurity, a lot of times that becomes a priority in my integration effort to adopt that for the broader organization. And so cybersecurity has become one of those drivers that help us improve our business prospects and maintain a manageable risk profile, and a lot more than it used to be, at least in my experience.
Scott, in previous conversations, you mentioned certain areas of the oil and gas value chain where cyber has really piqued the interest of energy leaders.
So if you think about, how critical the energy infrastructure and the energy complex is to our daily lives, as take ourselves out of this panel, we're just human beings at the end of the day, that when we get home, we expect our lights to turn on, we expect our water to flow, we expect our gas to light up and cook our dinners. So when those things are when those companies are the ones that are doing transactions, you're seeing more and more that the acquirer wants to make sure that the target has taken that into consideration, especially if that target's going to operate still independently or take a long time to integrate because of the complex systems that exist in, imagine running, power plants or electrical grids or pipelines. It's not so easy to integrate one pipeline with another, and the back office, goings on that run those pipelines, and how it takes years to integrate those things. So you've got to trust that that asset or that organization that you're buying is going to stand on its own 2 feet during the interim. Otherwise, the negative effects on the acquirer, and especially if it's a public company, can really be detrimental to the stock price. And so the boards really need to be taking a closer look, and I think they are, at these risks. Another thing I'll say is that some of the more sophisticated private equity firms are requiring that their portfolio companies institute very stringent cybersecurity protocols. And that's a business decision as much as it is just a rational one. But if you think about a target, you got an acquirer looking at a number of targets, and private equity funds are looking to monetize their investments. They want to make those targets attractive as they can. And so having a safe and secure cybersecurity protocol in place and system in place only makes that target more attractive to the market. So I think those are the big sophisticated private equity firms that are instituting those requirements now. And it doesn't just apply to cybersecurity; it applies to everything from financial reporting to management structure, and so and also governance. ESG is a huge topic of conversation in every aspect of every industry, I would say. So, cybersecurity, I think, falls into governance to a degree. You really need to look out for your clients. I mean, who are your clients as a pipeline? It's the end customer at the end of the day. It's you and me. And I think during the freeze that we had in Texas, I think we saw a lot of vulnerability in our system. I'll bring up one example of, if you guys remember, the Colonial Pipeline got shut down by a Russian hacker for over a week, and it cost billions of dollars a day in revenue and put a real stranglehold on the natural gas market because it was one of the it is the largest pipeline along the East Coast, largest pipeline in the country. And a big ransom had to be paid to get out of that situation. That's happening a lot more often than we may think it is, especially than the general public knows it is. And I think Amir can probably speak to this. It's a real issue, these ransom attacks, and they get paid, and it's a business for these people. So they're going to look for every opportunity to attack. And so I think, cybersecurity isn't just putting McAfee in place and walking away, or, you got to hire some real pros, a CrowdStrike or something like that's constantly monitoring and doing checks and providing you with the security that you need. And you're going to need some internal experts to integrate with those guys. But I think what you see in M&A is that because people are aware of this risk and how it can impact, the post-merger value of the deal, is you really need an expert to come in and sort of help you evaluate the risk. Because, let me put my CEO hat on. I don't really know how to evaluate cyber risk, right? I know how to run a business and put an organization together and manage my capital structure and so forth and so on, and generate business. But I need somebody else who has an expertise in cybersecurity to help opine on what the risks are that I'm possibly taking on in that transaction. So I think we're seeing an industry prop up around that, and I think it's good for transactions, because as a banker sitting in the middle, I'm looking for every way to get a deal done. So if I can get a third party in there to give a stamp of approval to the target, whether I'm on the sell side or buy side, it helps get a deal done. That's great. You can also put insurance products in place nowadays to help hedge some of that risk. But those insurance products pay off in the time of a claim. They don't actually help prevent that ransom from happening or that disruption to business from happening. They only pay out to try to help mitigate the financial costs of that risk.
Yeah.
Well, your customer still suffered. Your customer still got home and couldn't cook his food that night. So the risks are real, and the consequences are beyond the financial. So I think it's ultra important.
Right. It's tools versus having an actual governance process. When working through a due diligence, that's one of the key factors we look at. At a certain scale, tools may be okay. As hackers grow more sophisticated, having the right organization and structure in place is critical to developing strong cybersecurity posture. After we talk about ransomware, what are some of the technologies, processes in place to help safeguard an organization?
There's a lot of things you could do, right? One is, like I was telling you before, infrastructure security, right? This could be from anything like hiring an external company, like you said, from CrowdStrike, or your firewalls, your WAFs that you have, controlling, looking at traffic and everything like that. That's one way to control your infrastructure portion of things, right? But then there's the aspect of, I don't know if you guys have any kind of ingrown or homegrown tools that you develop in-house or anything of that sort, but keeping these tools and applications that are out there, especially the ones that are actually web facing, to keep them secure. That's one of the main keys to be able to not get to a point where some sort of a ransom is being held for your server. And there's been occasions where people they have some sort of a input in their web page. That web page input is not actually secured on the server side, meaning that anybody can go ahead and put in any kind of data and whatever the case is, and the server is just going to go ahead and accept it, right? That data that they sent, who knows? It could be some sort of a SQL injection code of some sort, right? They're actually doing something malicious to your database of some sort, right? And you didn't actually secure your application. You can't blame anybody but yourself for something like that. You know what I mean? So it gets to a point where if you're not looking at everything, not just infrastructure, but also when you're coding, make sure you're doing best practices, things of that sort. That's going to be the only way to prevent things from actually happening. And like I said, I can't speak from the other side because I try to keep my stuff very secure. So.
You had mentioned, Amir, you kind of work in the software space specifically. So is it, would you look for certain type of rigor in coding if an organization does have kind of a big homegrown kind of capability that they leverage?
Right. So it really depends on the certifications that your company or your application or whatever the case is, right? Like you could be PCI compliant, right? Where credit card data and things of that sort. But then there's also a side of HIPAA compliancy, right? For any kind of medical equipment and things of that sort. So what was your initial question again?
Just really on the software side, I know you mentioned you have experience in the coding and kind of the software development. So are there other things you look for in the software development process for companies that have a lot of homegrown software tools?
Right. So that's the thing, as I was saying, through the certifications or these compliancy bases, they have a set of requirements that you're supposed to meet, right? like for PCI, because that's the one that we actually mainly deal with. Things like, encryption in transit, make sure any kind of traffic that's going through the web is actually encrypted before anything is there. Encryption as rest, meaning once your database is sitting there, in a turned off state or whatever the case is, if somebody got physical access to your gear, they can't do anything once they actually see, grab your stuff. So, these are little guidelines that you have to follow, and not just, once you do it, you're done. No, no. This is, we have quarterly updates for these. And then there's the 1 yearly one that we'll do. Looks like the huge audit, right? So every application has to go through it. If you don't go through it, then, you actually lose your certification. If you lose your certification, you can't serve customers, So it's just the way it is.
Yeah, so Sal, from your side, what have you seen in terms of people and governance?
I don't know that I can speak intelligently or adequately to the specific cybersecurity governance side of things, but kind of following up on what Amir and Scott are saying, that's the the cybersecurity risk is unique in that it comes from a variety of sources for different root causes, if you will, or different drivers, and has domino effect implications on organizations, like the example Scott mentioned, the pipeline disruption. And those are, and if you look at those root causes, whether it's political, economic, technological, they're all accelerating organizations' appetite to protect themselves really effectively. Now, how are they doing it tangibly? That's probably Amir's is this person to speak to that. But my observation from my point of view is that I haven't seen cybersecurity become so central in transactional conversations as much as it is now. It's almost as, and one of the things you talk about, especially in the upstream sector and oil and gas, and then even other industries, whether it's a stock deal or an asset deal, you try and deflect some of the risk by buying assets so you can get away from maybe tax risk exposure and audits and such, or you try to lock in or leverage some of the synergies that a stock deal can bring if you have really good lease terms or something that creates capabilities and an attractive proposition. And each scenario has its own risk profile. Cybersecurity is the one that cuts across all of them. Even if you're buying only assets, those assets come with softwares to operate them, and there's all that exposure that comes with it. And so it really has become one of those center stage risks that are being taken much more seriously. But how is it being done as far as managing it? I don't know that I can speak to that. But I'm also, frankly, curious. Maybe Amir or Scott can speak to this. Also, when we do diligence in cybersecurity space, I'm used to seeing the outcome of that. But I don't really know what goes behind the scene in assessing a cybersecurity risk at a potential target, acquisition target, or merger target. I know it's becoming a lot more important, a lot more central, but I'm curious how our organization is trying to assess that risk and then manage it.
And you hit the nail on the head there at the beginning of your comment. There really aren't too many good examples of good, mature cybersecurity practices. And we've seen that across the table, across the different due diligence cycles. At the end of the day, when we're talking transactions, it's about the dollars and the financial impact. What are your thoughts on quantifying the impact of poor cybersecurity or specific types of cyber attacks?
I have never been able to quantify what the value of the risk is, whether, if it's more so, at least in a transaction, is the risk being mitigated to a reasonable level? Are they at least attempting? Did they have cybersecurity in place? And this will go to whether it's corporate governance, quality of earnings, all these things. I mean, I don't know if you can put a number or a value on any of those risks. And at some point, you're doing a deal and you say, okay, great, that risk exists. We're going to take on that risk and we're going to try to improve it out, in the post-merger integration. And if you're a buyer that feels that you can do that, then you'll go forward with the transaction. If you're a buyer that feels that it's a risk that you don't understand or that you can't mitigate or reduce in some form or fashion going forward, then you're going to have to really think hard about if you want to go forward with that transaction. So I do not think it's possible to put a number on it. In terms of the question prior about what does a company go through to try to evaluate the risk, I do know that you can go through sort of like what do you call it? I mean, basically like a hackathon, or you can go do simulations of what vulnerabilities are out there, and hire firms that can come in and sort of simulate that risk, and without damaging the company, go in and hack into it and find where the weak vulnerable places are. I don't know how exactly that happens because I've never done it. I've never sat there and watched people do it. But I'm guessing that that's how they come back with an evaluation of what the risk level is.
So if there's anybody that's possibly done a hackathon, Amir,
You try to hack into your own business, right? I mean, you try to find the vulnerabilities and see where are the back doors.
That's exactly what you're doing. And I mean, there are tools that are available that you can do this on your own, and you're just running a suite of vulnerabilities, known vulnerabilities, right? What it is, let's say something like, McAfee or any of these security companies or whatever, they're going to list out, you can go to their website right now, and they list out a whole list of different vulnerabilities that are out there, right? These vulnerabilities, there are people that are taking tools and saying, hey, we created this tool so you can actually evaluate your application by running this tool against it, and these are all the hacks that basically we're going to cover you for. So, I mean, that's one way, but then there's other companies like we have something called, I think it's called TVA, right? And then what they do is they scan us on a daily basis. And for us, they go a little bit deeper, right? You could just have the scan of your website or whatever your publicly exposed things are, right? In our case, since it's an internal company and coming into our department and doing everything, they actually have full access to our servers, right? So servers, code, everything of that sort. So basically, they're not just running it against our APIs and web services. They're actually going into our servers, making sure the logging is even not throwing out passwords or bad data that can be used to hack you later on, of that sort. There's a lot of different aspects that you could do to secure yourself, but hiring a company, if you're not comfortable doing it yourself, is probably the best way to go, right? So,
completely agree. Much safer to find a trusted partner in most cases. I want to give everybody an opportunity to share their one key takeaway organizations should take into consideration.
I'll take the 30,000-foot view just because kind of that's the place I've been living in more recently. Transactions historically have been primarily driven by the synergies, the opportunities, the added capabilities that organizations are able to acquire via a transaction, whether it's market share or technology or and while this is obviously still important drivers in your strategy thesis for M&A and such, it's more paramount than ever before to also pay attention to the downside of that the transaction can bring, such as cybersecurity. So the risk exposure, not only opportunity assessment, but also the risk assessment has become almost, and I don't know what others feel, but I want to say almost equally as important as the opportunity. Unlike before, where the primary focus was on the opportunity, there was a quick, brief scan of the risks, if you will, on the average transaction. Obviously, they vary. But the risk was not center stage. Today, that's not the case. And so if I am considering a transaction, I would urge those leaders to not only evaluate the opportunity, but also evaluate the risk and take it as seriously as they do evaluating what kind of synergies we're able to realize from this transaction or what kind of capabilities we're able to acquire. So again, I'm kind of hammering this idea of
Mhm.
it's really critical, it's really important, and the risk does not look like it's going to moderate going forward. If anything, it looks like it's accelerating or becoming a lot more tangible. And so it's really important to factor that in due diligence, and specifically in IT and specifically in cybersecurity.
So, there's kind of a saying, I think you guys have all heard it, but if somebody were to ask me, what risk am I most concerned with? And it's always the one that I don't know of. It's the unknown. It's the one that just comes out of nowhere and sweeps you off your feet and knocks you on your butt. So I think when you put your M&A team together, you need to put a group, I'm talking from a CEO's perspective. You get two CEOs together in a room, they hash out the big deal. They got the price and the terms and all those things. You need to have on both sides of the table an M&A team that is evaluating the risks internally and on the other, on the acquirer side. And because as a target, especially if you're doing a stock deal, you want to be acquired by a target that has, solid footing. And so you need to be doing your diligence on them as well. And so the teams need to be working behind the C-suite, helping provide the C-suite with the information they need to understand what the risks and the opportunities are between the two parties. And so, who you put on your M&A team is very important. You don't want a bunch of sales guys trying to get deals done, and you don't want a bunch of naysayers trying to kill the deal because there's risk everywhere. So, I think that's the art of the deal, and that's where, that's where deals get done. Is you figure out where you evaluate as many of the risks as you can, and you accept the risks that you don't know and you can't see, and you just accept that you're going to have some sleepless nights worrying about them.
Yeah, no, honestly, what I would, advise and suggest to everybody is follow best practices. As an IT person, right? I mean, that's the best thing you can do. I had the luxury of getting trained by a jackass. Sorry. But, those are the good types of people you want in that industry, where they're very particular about how you do things and when you do it and whatever the case is, right? And just following best practices. So by that time, we got around to the point where we were getting audited. We didn't have much work to do, right? Because we're already following the best practices. We're passing through everything. And that is honestly the best thing right there. So, yeah.
And with that, I want to thank our panelists for their time and expertise. And thank you for listening. Again, hope you've enjoyed our discussion and look forward to speaking again soon. Thank you very much.